Adjunct Professor Moran, Microeconomics, 112. We're discussing the concept of rent, the payment for something for which the quantity does not change when the price paid for it does. The connection between price and quantity supplied is broken, so we no longer call the payment for something for which the quantity supplied doesn't change price. We call it rent. This is unlike the definition of used in general terminology where rent is something you pay for an apartment. Economic rent is defined as a return over and above the opportunity cost or the normal return necessary to keep a resource in current use. Economic rent is any payment to a resource above the amount necessary to induce the amount of the resource to be employed. So in other words, a higher rent does not encourage more land to be produced. Economic rent can also be defined as the amount over and above the opportunity cost necessary to keep the resource in its current use. At $1 or 1,000 an acre of land, the quantity does not change. And since the cost doesn't change, the payment wouldn't cause the quantity to change. Assume that the quantity of a certain type of available land is 300,000. And the demand for land is given here. Demand. Here's the supply of land. Regardless of the payment, the number of acres is 300,000. There is no positive relationship between the payment and the quantity of land provided. So instead of land price, it's called land rent. So there is an active and passive determinant of the price that will be paid. The active determinant is demand, because demand will cause, given the supply of land, the payment to change. But the amount of land available is passive because it does not change. So at $350 there will be 100,000 acres demanded. So we'll plot our demand schedule into a demand curve, a negative relationship between price and quantity demanded. At 300 there is 200,000. At 250 there is 300,000. $200 an acre there's 400,000. 150, 5, 150. My favorite first grade activity, connecting the dots. This is our demand curve. This is our supply curve. The pure rent on an acre of land will be 250. Total quantity of land will be 300 acres. If landowners were taxed at the rate of 250 per acre, the pure rent on this land would be 0, but the number of acres available would be 300. The price of the land does not affect its supply. That's why it's called rent. Now let's look at rent of land, but this is really a very clever discussion of marginal cost and marginal benefit analysis. If you'll notice, every chapter in microeconomics has had a decision rule that morphs marginal cost equals to marginal benefit into the optimal amount that will be produced. In our last unit on wage determination, it was marginal resource cost equals marginal revenue product. Before that, when it was competition, it was marginal cost equals marginal revenue. So that is built into this analysis of rent. How much would you pay for land when the quantity available is not changeable? We're given this table. How much should you spend on fertilizer for land? And there are 3 different qualities of land. So when you spend the same amount of money on fertilizer, you'll get different total revenues or crop yields coming out. Notice the higher the quality of land, the higher the total revenue that comes out at each level of expenditure. They want to know if the product sells for $1, how many dollars per acre should be spent. Okay. To do that, you have to expand your table to have the decision criteria built into it. And the decision criteria is marginal benefit, marginal cost. Here's a file provided online that provides that analysis. Here's our original table. If $100 is spent on grade A land, it will provide $175 of crop. On B land, it will provide $160 worth of crop, $120 on C. $200 yields a higher amount of crop, $325. $300, $450. $400, $525. $500, $575. And $600 of fertilizer will leave, $615. These are totals, but decisions are not based on totals. Decisions are based on marginal analysis, marginal cost, marginal benefit. So we need to build our table out to include our decision criteria, marginal cost, marginal benefit. Well, if the total spent on land is 100, 200, 300, 400, 500, 600, what are the marginals? Well, these are costs. So the marginal cost of going from 0 fertilizer to 100 fertilizer, 100. To go from $100 of fertilizer to 200 represents another 100, or a marginal cost of 100. Total cost of fertilizer of 300 compared to 200 yields a marginal cost of 100. 3 to 4, 100. 4 total to 500, total 100 marginal. 500 to 600, total a marginal of 100. Now, what are we getting for these extra expenses would be the marginal benefit. If the total revenue on grade A land of spending 100 is 175, 200 is 325, 300 is 450, 400 to 525, 500 to 575, $600 of fertilizer, total revenue of 650, 615. Well, these are all going up. Which is the optimal amount? Which will maximize our profit? We need to know a marginal analysis as a result. If we spend 100, we'll get 175 in total revenue. That's a marginal benefit of 175. Increasing our expenditures from 100 to 200 will increase our total revenue from 175 to 200, 325. That's a marginal benefit of 150. Increasing another $100 on fertilizer will increase our total revenue from 325 to 450, a marginal benefit of 125. 450 minus 325. Another $100 in fertilizer will achieve an additional amount of revenue of $75. 525 total minus 450 total in the prior amount. Increasing expense another $100 from 400 to 500 will cause our total sales to go from 525 to 575, a marginal benefit of 50. Finally, 500 to 600, a marginal cost of 100, will yield an additional benefit of $40. Our total revenue rises to 615 versus 575. Similarly, for B land, increasing marginal cost 100 each time will cause total sales to rise from 160, 290, 375, 445, 490, and 525. Subtracting out, trying to determine marginal benefit, 160 minus 0 is 160. 290 total minus 160 total gives a marginal benefit of 130 for spending the extra 100 on fertilizer. 375 minus 290 gives a marginal benefit of 85. 445 to 375 marginal benefit of 70. 490, 445, 40 is 45. And total sales of 525 when we spend $600 on fertilizer is an improvement of 35 over the prior amount of 490. C, total revenue, no fertilizer, no crop, 100 and 120, 200, 210, 300 fertilizer, 290 total sales, 400, 330. Okay. The marginal benefit is 90, 80, 40, 30, 25. Okay. Now, should you spend the money? Would you spend an additional 175? Would you spend an additional 100 to get 175? And the answer is yes. So you're going to spend the first 100. Would you spend an extra 100? Would you spend an extra 100 to get an extra 150 in revenue? Yes. Would you spend an extra 100 to get an extra 125 in revenue? These are all marginals. We're comparing marginal cost and marginal benefit. Yes, you're $85. You're an extra $25 better off. Would you spend an extra 100 to get an extra 75 in benefit? No. Your marginal benefit is less than your marginal cost here, so you would not do this. So you would spend a total of $300, because here your marginal benefit is 125 compared to your marginal cost of 100. And so the decision criteria is marginal benefit greater than or equal to marginal cost. Let's look at quality B land. Here your marginal revenue and your marginal benefit. Your total revenue and your marginal benefit. 290 minus 160 is 130, 375 total revenue minus 290 at the prior amount of fertilizer gives you a marginal benefit of 85. At 400 fertilizer, your total revenue is 445 compared to your prior amount at 300 fertilizer gives you 70 marginal benefit. 490, 445, 525, 490, 35. Would you spend an extra 100? Would you spend an extra 100 to get 160 in revenue? 160 benefit, 100 cost. Yes. Would you spend an extra 100 marginal cost to get an extra 130 in marginal benefit? Yes, you're $30 better off. Would you spend an extra 100 to get $85 in marginal benefit? And the answer is no, because your marginal benefit is less than your marginal cost. So on quality B land, they will spend $200 in fertilizer and get $290 in total revenue. Quality C land, would you spend an extra $100 in fertilizer to get $120 in benefit? Yes. Would you spend the next $100 to get an extra $90 in benefit? No. Your marginal benefit is less than your marginal cost. To summarize this, notice that at the optimal amount for quality A land, you're spending $300 in cost for fertilizer to get $450 in total revenue. That results in a profit of $150. You would not spend $400 in fertilizer because it would only result in $525 of total revenue. Your total profit would fall to $125. You would not profit maximize, so you would not do this. On quality B land, notice that its marginal cost is greater than marginal cost. Here, marginal cost is greater than marginal benefit, so you would not do this. Marginal benefit, marginal cost, marginal benefit less, marginal benefit more. On quality B land, would you spend $100 to get an extra 160 in revenue? Yes. Would you spend an extra $100 to get an extra 130 in revenue? Yes. Would you spend an extra $100 to get $85 in extra revenue? No. So here for quality B land, our total revenue will be $290. Our total cost will be $200, and our profit will be $90. If we went further and spent an extra $100 for $300, we would earn definitely more, $375, but our profit would fall to $75, not as much as $90. So you're going to produce where marginal benefit is greater than marginal cost. 130 marginal benefit compared to an extra $100 for marginal cost. If you go further, your marginal benefit is only 85 and your marginal cost is 100. You would be reducing your profits. Quality C, to reinforce this concept once more, would you spend $100 on fertilizer to earn an extra $120 in revenue? Yes. Would you spend an extra $100 for a total of $200 to earn an extra $90? No. At that point, marginal benefit is less than marginal cost. So you'll stop here where your marginal benefit is 120 and your marginal cost is 100. Your profit will be maximized. Otherwise, your profit falls to 10. Note that marginal benefit compared to marginal cost is less, which results in a lower profit. This concludes our discussion of rent and includes the discussion of marginal benefit, marginal cost analysis, which underlines all concept in microeconomics.